Hello YouTube, this is the Average Investor here again. This is my next video on the pearls of wisdom of the intelligent investor. In this video I will be discussing the continuation of chapter 8 and I will be discussing Dow theory and timing. Dow theory and timing is basically based on the idea of buying when one sees a breakthrough of averages on the upside and selling at a breakthrough on the averages on the downside. If one used this theory back in, say, the 1897 to 1960, one would see a large sum of profit as per the Intelligent Investor of Chapter 8. If you look at this example of the Dow Jones, you will see usually people would sell where the average would move below the 50-day average, where it would say sell now, and then most people would then buy again after the average moved above the 50-day average, or say the 200-day average, and buy then. And the idea would be, oh, I'd make more money if I continue waiting for the averages to cross each other, buying and selling as the averages cross each other. A closer study of the Dow theory showed results changed dramatically after 1938. During this time, it became widely accepted, and following from 19 and if one followed from 1929 to 1933, when very few followed this theory, one would have done very well. But if one looked or followed or used this theory from 1938 and on, the results would actually be very mediocre. And this is due to essentially too many people following the same theory. So as I've said before, these changes in results from 1938 and on were due to the fact that formulas became popular, and as they became popular, their reliability falls. So Dow theory and timing is this essentially just one method or one formula people followed. This The reason this would produce mediocre results was because of two reasons. The first being that as time went on, new conditions were introduced which would then no longer fit the formula. And as I've said before, the second reason was because the theory itself affected the market's behavior. And since there are more and more people following this theory, the market itself would change because of this. And thus, with too many followers, one would get mediocre results because everyone is following everybody else. So that's basically Dow theory and timing. Future topics on the continuation of chapter 8 from the Intelligent Investor, we'll discussing the idea of a buying low, selling high approach, and more on formula plans. Thank you very much.